Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to look at three stocks that are down more than 10% after they reported earnings today. And I'm just going to share my thoughts on them. If relevant, I'll share a buy price that I'll be looking at. I think I've covered all of these on the channel at one point in the past, but it's been a while for each one of them. As always, this is not individual investing advice, just how I analyze stocks. Okay, so someone messaged me about Whirlpool today because I covered it a while back, and it's down about 13% today after they reported earnings. And they noted that I had said that they would probably cut their dividend, and that might be a time to buy. So if you look at dividends, let's see, which one do I want? This one, the yellow line. Okay, so they had kind of held the dividend steady. I just saw the headline that said that they were going to cut the dividend, so I don't know how much it's going to cut by. But it was pretty obvious that this was probably going to happen, and that you probably didn't want to buy the stock before then, at least. So that's all been kind of proven out now, and we are down at a pretty decent low. However, my buy price for the stock, treating it as a deeply cyclical business, this is probably based on 2008 decline, is still 77.30. So we still want it. It still needs to go lower, basically, before I would even consider buying it. And then I will have to. A lot of times with deep cyclicals, I know ahead of time. Look, if they hit the price, I'm gonna buy it. Oh, I say right here in my comments, we'll want to see a dividend cut and positive momentum before buying. So we got the dividend cut. And then it needs to get below this price, and then it needs to start coming back and have formed some kind of a bottom. It doesn't have to have an earnings bottom yet, but probably if the stock forms a real bottom and momentum picks up, it means the market can see positive earnings growth coming in the future, and we just aren't there yet. One of the reasons I'm being so caught, usually I buy deep cyclicals on the way down as soon as they hit my buy price, and I can bottom tick or get close to it a lot of times. But these guys have a lot of debt, and they don't even have an investment grade credit rating. So this is going to be a dangerous one to buy. And when the risk is that high, then you want the moment when they're coming out of a bad recession. You can get the reward, I guess, is potentially worth it, and you're at least reducing the risk a little bit. So if we go back to 2008 here, let's say you didn't buy at the bottom, but you bought it like coming out of the bottom or something, I don't know, somewhere around there, and then you hold a few years, you get like a 300% return, right? Now, they could have gone bankrupt, right, back then. But if they don't, and the economy recovers, then you can make some pretty good money. And I wasn't even picking like the very tip of the peak. It's possible maybe you wanted to wait a little longer before buying, but you still can do really well. You can get a couple 100% return potentially. So this one is really on the edge for me, but so I set the standards pretty high in order to buy it. The price needs to be low. It needs to have, so I don't think those things are probably all going to happen. But if they do, it might be enough to tempt me to buy a little bit, if that makes sense. But so far, this is playing out pretty much how it looked like it was going to. Not really any surprises here. I didn't think it was a buy yet. And I think that was a good decision. All right, so stock number 2 is, I think I had them on my spreadsheet already, so you probably saw them, UPS. So I've been really negative on this one. I thought management's decision to raise this dividend this much, it went from $4 a share to $6 a share, and then they kept raising it a little bit, even to $6.48. Now earnings are expected to almost be lower than the dividend, and I really feel like this is one where dividend investors, like it was like designed to get dividend investors in, and I could sound the alarm bell on this one as much as I possibly could. There were cyclical risk, boom bust risk from the pandemic. That was the initial risk, I would say, of the past 2 years, and now we're getting into more potential structural business problems. And so they're basically downsizing and cutting, trying to, because they have competition from Amazon, especially, I think. And so and it's just not a good thing to be buying. So the fact that it's down 10.5%, probably a 52-week low, if not multi-year low today, doesn't surprise me one bit. I didn't see if they cut the dividend. It's yielding 7.22%. I would sometimes these work out, and if they do, that's great. I would not be buying it for the dividend still. I mean, if you bought for the 5% dividend, I just picked a random spot, not even near the top. You're down 36% now in the last year. So you just want to stay away from these. And so in my spreadsheet here, what do we have? I don't have a buy price for it. Earnings growth is too slow. It's that simple. And now it's even worse. So I did kind of have a 4% growth rate. This 3-year revenue growth, which I haven't even updated with the newest number, has been pretty deeply negative. Some of that can be explained, like I said, by the pandemic boom and then bust in goods. But we're now looking at earnings lower than pre-pandemic. So that's worse than a bust from the stimulus money and not stimulus money, right? They have bigger issues. I think raising the dividend here was 50% was insane from an investor standpoint. So that's all I got to say about that one. All right. Brown and Brown. I do have a video on, I found an old video on this one. I saw a few people were looking at it today, probably because of the decline. Fell 10% today. I did have to read up on this one just a tiny bit because I wasn't sure why at this particular time it sold off. But so my last video, it was about valuation, at least according to the title. It came out over a year ago, I think. This one, I'm going to go ahead and share a buy price. So what I want to show everybody here is I'm going to model my buy price. I'm not going to go through the whole process and explain it because it's like a quick video. But I'm going to model it off this 2008 decline right here, which we can see how far the stock fell. I'm going to use an earnings base. So it fell about 50%, the stock did. But what's interesting is at the peak, if you think of the housing peak, these guys are insurance brokers. I think it has to do with real estate insurance in some way. Maybe it's title insurance. I'm not sure exactly. I forget. But that doesn't really matter because I'm basing this on previous market reaction to earnings declines and recessions. So 31 peak PE, okay, right before the Great Recession. The peak that we've kind of established here now is almost exactly the same, 31.72. But the stock price decline is much faster. It took, well, we aren't down 50%, but we're halfway to 50%. It took from April 2006 until a year and a half, I would say, until the recession started officially. But the housing market peaked right then in 2006. And then it took a year and a half or so for that to work its way into the rest of the economy. I don't know if that's going to happen now, but we definitely have a somewhat similar setup where we had really low interest rates and then interest rates went higher very quickly. So I think mortgage rates, if you have a good credit score and everything, are maybe in the 6-7% range right now. That's much higher than, like, my mortgage is like 2.62%, much higher than that. So for people who are just going out to get a mortgage and buy a house. And I just saw an article today on CNBC where median home prices are at a record. So, I mean, this market just seems like it's not a whole lot of, happening for housing, if I'm remembering this right, and that's what it has to do with. I could be wrong. I'm sure somebody will correct me in the comments. Again, it doesn't really matter for the method I'm using here. But I just noted it because I noticed that 2006 early earnings peak rather than when some of the other economic parts of the economy peaked. So if we base the potential decline could come on the 2008 recession, I have a recession PE model that I use, that takes the low price and the high earnings and creates a PE ratio out of it. And then I do a couple other things. That which is usually at the beginning of a decline, it looks super low, and it looks like the business will never happen and it will never hit that. That's about $53.24. This won't change too much. I doubt it would go below $50. Yeah, they are. I am using forward earnings to do this. So if this $4.17, if they missed that for some reason, I would use $3.84. That would lower that buy price a little bit, but we're looking around the $50 range. I wonder what it was here. See, that's just what it was in 2023. That is not a crazy, I don't think that's a crazy buy price at all. See when it bottomed then. 53. Yeah, that's almost right where I'm at basically on my buy price. So if it got down there, I might nibble at this one, even if things are really bad and it looks like we're going to a recession. I will say, I just read through a couple things really quickly before I made the video. It looks like they made an acquisition, and they made a bunch of acquisitions. So that's kind of what they're doing right now. But one of them was a little bit bigger. It looked like it was $4 billion valuation, and it's a $30 billion company. So if you add that, we'll call it 12% of the market cap for the acquisition. 20% is kind of the threshold I use where I just avoid the business altogether. Now, maybe if you added in some of the smaller ones, you might get closer to that. So that's kind of borderline as well, kind of a warning signal that, because usually companies make bigger acquisitions when their growth is slowing more than they want it to. That's not always the case, but a lot of the times it is, and it's just an easy kind of signal that, okay, they can see that things aren't going to grow as much as they want, so they're going to go try to buy that growth. So I would be a little bit more cautious, maybe not using normal valuation, partially because of what we saw back in 2008, and then partially because we do have pretty acquisitive business here, where expectations are pretty high. So they beat their earnings, it sounded like, and the stock still sold off 10%. So you can tell people in the market are a little jittery here. I don't know if it's justified or not, but I like to buy stocks when they're cheap. So I would rather buy it when it's down at this price than when it's where it's at now. And I'm willing to wait and see if it hits it. So that's kind of the quick take on Brown & Brown, which is also down 10%. So these were kind of very quick feedback and kind of superficial to some degree, but I do have other videos. If you search for them on my channel, you can go watch the old ones where I might get into more of the business stuff. I really just picked out the top one thing that maybe I have 2 things that I care about that I'm watching. Okay, if you found this useful, hit the like and subscribe button. I have a free tier over on Patreon. Check that out if you don't want to miss any of my videos. And I also have weekly picks. We just had a weekly pick today over on Patreon, and that service is $25 a month. We're doing really well, getting close to the first year of doing the weekly picks. I'm also over on Seeking Alpha. I've been writing there this is my 10th year, writing about investing, and you can check me out over there too. And I'll see everybody later.